Welcome to the Broken Pie Chart Podcast, episode 243. Had to think about it there for a second. I'm your co-host, Derek Moore. With me once again in the seat is my semi-permanent co-host, Jay Pestrichelli, fresh off the road. You were at the Options Risk Conference this week. How you doing, Jay?
I'm doing well, Derek. Yes, I know. I feel like it's been months since I've been here. Has it been months? It's been, what, 2 weeks? Maybe.
It has been 2 weeks since these listeners will have heard that. But yeah, by the way, not too much going on. I say that with a smile. No, a lot going on. Let's start here. You were just at the conference, and one of the things you were seeing was a lot of talk about how options are growing in popularity, growing in new ETFs that are forming using options. But it got me thinking because, normally 60-40 or any bond and stock build, the whole idea is that bonds go up when stocks go down. And so when you rebalance, you sell more of the stuff that went up, i.e. the bonds, and bought more equities. Not the case this time. Stocks and bonds are correlated, and bonds are performing horribly because of the rise in rates. So Jay, it's just kind of a bizarro thing where people who are rebalancing, whether it's monthly or quarterly, whenever they're doing it, using traditional stock bond portfolios, especially longer duration, as bonds are going down, they're actually selling more stocks to buy more bonds. And then as bonds go down again, they have to sell more stocks to buy more bonds. Like, it's not supposed to be that way, Jay, which is probably why they talked about it at the conference.
Yeah, we definitely talked. It is the risk management conference that SIBO puts on, the Chicago Board of Options Exchange, every year. It's one of the things that we always go to at ZEGA. We really like to hear what the rest of the industry is doing, portfolio managers, market makers, money managers, all sorts of interesting folks. A lot of discussion around, how traditional risk management is failed people the last year or two and continues to do that. Just a lot of discussion around how derivatives can help offset certain risks, right? Helps you really identify it, talking about some complicated concepts of, you want to have dispersion in your portfolio versus correlation. And those are a lot of syllables in those words, right? But the point was, you have to look for new ways to, manage the risk in your portfolio. One of the big topics was cash. Like, should we go to cash? Should we not go to cash? And, a lot of discussion around, what you're giving up being in cash. And of course, we're all money managers there, so none of us think cash is a great solution. But we all know it's a more interesting topic now with rates where they are than it was, say, a year ago, 2 years ago, 3 years ago. So, you have to, if you're going to provide value as someone who's actually making investment decisions, you got to find it in different places than where you looked before. So really interesting stuff at the conference. I would say the industry is absolutely tuned in to what is going on intraday in Treasuries. I'm trying to think back 2, 3. I've been going to this conference for 7 years. No one ever talked about Treasuries. So it's nice to see the pulse, the fingers on the pulse with really some of the smartest people on Wall Street.
Yeah, no, and it's, I think, not even knowing, and as I was doing the prepping of the show, you and I, we do this, we write down topics, or I said, it's just really interesting, and this whole rebalancing thing. Like, it's almost like the way stocks and bonds are acting, you continually are you're almost overweight bonds because you lost on bonds, and then you got to sell more equity to buy more bonds. You know what I mean? It's just, they're not doing what they're intended to do. And this is what happens when correlations go higher. But this is a rate story. And I think a lot of managers who maybe haven't been in the business that long, I remember in the 90s, I wasn't managing money in the late 70s, early 80s, but I remember higher rates. So it's just, I don't know. I think it just shows that there is a need for other approaches, other hedging approaches to manage risk, and kind of why we buy and hedge, Jay,
Yeah, I mean, there's so many more tools at our disposal now, whether it's whether it's directly using options and derivatives yourself, or even using funds that incorporate options, right? There are tail risk funds out there that you could just buy. You don't have to be the expert. Let the experts do it, and you buy their fund. There are hedged equity funds like some of the ones we run that have upside exposure, and the hedge is built in. You buy the fund, right? It's okay. As long as you know that the world is kind of evolving, and the last 3 years, that idea of 60-40 stocks and bonds with that kind of a mix is, I think this will probably be the third year in a row that that's going to fail. Right? That's not really happened before. And by the way, stocks can be correlated to bonds. That is not, we're not in this, absolutely unusual situation.
More often than people realize. They're correlated much more often than people realize, Jay.
That's right. That's right. Except this time they're all correlated on the way down, right? And everyone's going, "What's happening?" Nobody cared when they were correlated on the way up,
no,
right? But they're correlated now on the way down, and it's just making it harder, right, for people to use that as a tactic of offsetting risk.
By the way, somebody sent me a great quote, and they said this person must have been really smart. And the quote was, "There is a real possibility that we are setting up for a lost decade with respect to bonds total returns." And I failed to realize that was actually the opening sentence in my book, Broken Pie Chart, from the chapter, Why Bonds Past Performance Can't Equal Future Results. I forgot it was even my quote, Jay. But this shouldn't...
Brilliant. So you impressed yourself. It's great.
I did. I said, man, that person must be really smart. No, I mean, the other thing I keep saying this, and Jay, we're not going to do a big deep dive on bonds. We'll talk a little bit about bonds later, but it shouldn't be a surprise given how low rates were. If you had any bout of inflation or any rise in rates, like this is simply what happens. This shouldn't be a surprise.
Shouldn't be a surprise. No, it's funny, Derek. I'm gonna give you credit. I mean, I'm gonna take a little bit of credit on this. We have been talking now 9 months about the fact of, look, rates don't have to go down in order for the curve to, uninvert, right? And what we're seeing now is the market starting to go, maybe the way that the curve normalizes is by longer ended rates going higher. And the market is, digesting that right now as a real possibility.
Jay, you sent me something earlier this morning, West Coast time, 4 a.m. So I know you were up early where you were. And Jay, you send me stuff for the audience. You send me stuff all the time. Doesn't mean my alerts are on,
This wasn't a weird thing for me to send you something at 4 in the morning. I do it all the time.
It makes up for the fact that I send you stuff at like 1 o'clock East Coast time when I'm still doing stuff. So, but you sent me this. It was a good piece from the Wall Street Journal, and there was also a piece from Bloomberg. And the question the Bloomberg article asked is: the bond market running sort of rates and the markets, or is Jay Powell running rates and the markets? And I would say that really the market is in charge right now.
Yeah, and I don't think Jay Powell is upset about that, right?
No.
I mean, he had the interview. He does this annual interview at the New York Sports Club, right, where he does that. He talks about, it's almost like a mini, Fed meeting, right?
Yeah.
And he talked about like, yeah, this is kind of the way it's supposed to be, and this is going to help, reduce economic activity to beat down inflation. He's still all in on trying to beat down inflation, right? I feel like he hasn't wavered on that at all. But I'm not sure he's necessarily upset that the market is like now doing his job for him that he's been trying to communicate for so long. And it's been a long time. It's been over a year. Remember when he yelled at everybody in August of 2022? He didn't yell, but he kind of like, you're not listening to me. It was like one of the shortest press conferences like he's had. Was it like 7 minutes, 6 minutes? And basically said, listen, everybody, rates are going to be higher for a while. Like, I don't know why y'all think it's going to go down, right? And then walked off, and then the market proceeded to just, bury itself. But yeah, like I think he's probably encouraged that he now doesn't have to act. He still has to just stick with the line of higher for longer. We got to beat down rates. And the market is starting to do its job for him. Now, what we haven't seen is actually the impact yet, right? We had a great claims number this week, right? Like the lowest jobless claim number in a long time. Retail sales up more than expected. Like the economic activity has not yet waned from this scenario of higher for longer. We all know. Well, I shouldn't say we all know. We always assume. We take the position that the markets will be ahead of the actual economy. So 6 months ago, the markets were still kind of just about to start their rip higher. And we kind of topped out in July, but we started that run in May. So we're coming up on the 6 months ahead of time. So as we see the market kind of pulling back now over the last 3 months, maybe that is when we start to see the economic activity slow down. Who knows, right? It's not an exact predictor, but back to your point, I think he's happy that the markets are taking over the interest rate story from him.
The other part of this is in the US, we don't do currency interventions necessarily. The Fed is not going in and buying bonds right now. In fact, they're letting bonds run off their balance sheet. I don't believe they're actually actively selling bonds, but they're letting them run off. Jay, earlier this week, the Bank of Japan on Wednesday had an unscheduled bond buying. That means that they're going in and buying, the Japanese central bank buying bonds, trying to keep the yields lower, meaning buy bonds, bonds go up, yields go down, that type of thing. Their bond yield on the 10-year, the JGB, is pushing 0.9% now, just a little bit under. And the yield is up after they started the intervention. It's a good signal for me that the market is in charge here, Jay. And I can't make the same correlation here, but maybe with the way that auctions are being issued. We had a 20-year auction that was received pretty well. But some of these auctions, bonds are going out, below par. The bids are not quite there as they once were. So I think these are two examples. The market's in charge. It's not Jay Powell, but I agree, Jay. He is more than happy to ride the tails of the higher rates to do what he wants to do, right, Jay? I mean, he wants you to lose your job, and he wants you to stop buying stocks, and he wants you to, I say that sarcastically, but like they don't want the economy to do too well, right?
It's too hot. Of course, he's said that, and he's even said there's going to have to be a little pain as well.
I
He said
agree.
that too.
Speaking of pain, mortgage rates, and
Ouch.
Yeah, let me do this, and then I want to talk about a little volatility stuff too. But let me just kind of finish while we're on bonds. Mortgages, so when people go on and they look at a mortgage, the rates are above 8% now. There is an index which sort of, I don't know how they build it, but it looks at mortgages all around, and it's hit above 8% right now. What's interesting to me, though, I calculate every once in a while the spread between the 30-year mortgage and the 10-year Treasury yield. So 10-year Treasury yields are right around 5%. If your mortgage is 8%, the spread is 300 basis points or 3%. This is 2.5 standard deviations above the average. Average is about 170 bips or 1.7%. And this goes back to 1971 is when I have the data from. And I have a theory on this, and I think the reason is it deals with the MBS market, so mortgage-backed securities. These are products that are, think about, you sell a mortgage and a bond buys a bunch of these mortgages, wraps it all up, and it's a mortgage-backed security, right? So won't get too much into that. But mortgage-backed securities right now, they have, okay, here's a little 101. I'll try and do this as simply as I can for a podcast audience. Mortgage-backed securities are essentially bonds. They're fixed income. Most times, bonds like Treasuries or corporate bonds, when the further rates go down, the more they accelerate up in price. Rates go down, bonds go up. But the lower that yields are, the greater the impact from a 1-point change in interest rates. MBS bonds actually work a little bit differently. And the reason why they work differently is they typically have what's called negative convexity. I'll explain that in a second. But as yields go higher, the sensitivity to interest rates changes differently. And what you see is durations actually elongate. And the reason why that is, in simple terms, think about it, Jay. Like if you are, let's say, you're buying a bunch of mortgages, and one of the mortgages is mine. Well, if I have a 3% mortgage and interest rates go to 8%, or the mortgage rates go to 8%, I'm not refinancing that. You will take that from my cold, dead hands before I give that up. So unless I have to move or I want, whatever it is, I'm staying in that. So what happens is when rates are going down, loans are prepaid, they're refinanced, and so duration actually drops. It's an interesting phenomenon. And I mentioned convexity. Convexity is just, it's a really fancy term. But all it is, it measures the change in duration for a given change in rates. Positive convexity says that, hey, when duration lengthens, durations get increased. And when we say duration gets increased, the sensitivity, the risk or gain from a change in rates also rises. When bonds have negative convexity, duration actually lowers. Sensitivity to changes in rates goes lower as rates fall. So typically MBS are opposite from regular bonds. But Jay, I haven't seen this going back to the mid 90s ever, where MBSs have positive convexity. So I usually give you a lot of technical stuff that I've tried to really simplify. But Jay, maybe maybe we can stop there for a second and clean this up
Well,
a bit.
no. I think you did a great job explaining it, Professor. So basically, when you have low rates, people hold on to it longer. Short rates, they want to get out of it sooner, right? When they have higher rates, they want to get out of it sooner, right? I mean, that makes a ton of sense. That's behavior that anybody that's ever had a mortgage understands, and that impacts the value of that mortgage, right? Because right when you buy a bond, right? I mean, the expectation is it's going to be held to maturity, but that's not the case when it comes to mortgage-backed securities, right? So I think you did a good job explaining that, Derek. Now, I don't know what it implies that we now have, positive convexity. I'm like, what does that imply now? Does that imply that the mortgage-backed securities that are being held today are now riskier? Because are they more sensitive when they shouldn't normally be, or are they less sensitive?
Well, I was talking to Mark Pulowski, one of the analysts over at State Street. I have a frequent call with them, as I know you're on those sometimes as well. Our partners at State Street. And he actually, I got to be honest with you, I didn't really catch that this had gone positive, but he mentioned it, and I was shocked. And it's nice to be shocked every once in a while. But one of the things that he was making a point of, he said, "Look, a lot. Think about all the bonds that are out there. The amount of bonds, the percentage of mortgages that are outstanding that are above 5% right now is still pretty low. And so one of the things he pointed out is that even if rates go down, a lot of these bonds are not going to get refinanced. So durations may actually stay higher even if rates go down on here.
We're normally people will be like, "Oh, rates are down. Let me refinance and get out of the one I have," but they're not going to go low enough to where they were in say 2020 and 2021.
This is very unusual. Like if it wasn't complex and if it wasn't MBSs, this would be on CNBC being like, this has never happened. Actually, I only have data going back to 97. So, but I was, anyway, so it's one of those things that there's all these going from such low rates to high rates and then having this stuff happen right now. It's creating these anomalies in the markets and things that people haven't seen before. I was surprised by this. And I remember higher rates in the 90s. So I don't know, but I think it also goes to the reason why, in theory, if it was the average spread, 10-year at 5%, 1.7%, you'd expect the 30-year mortgage to be what, 6.7%? It's not. It's 2.5, it's 300 basis points now. But I think this also has to do with demand, right? I mean,
Yeah, that's exactly right. Yep.
Weren't you telling me you had? I mean, it seems like they don't even want some of these loans, so maybe that's part of it too. Like they're just saying they're jacking it up. It's like, hey, if you want a loan, you're gonna pay us this. Go for it. I mean, have you seen that, Jay?
Yeah. Well, yeah, no, that's right. We have a client that was getting a loan for a property, and it was an investment property, but still planning on getting a loan. And what he told me was that the rate it's higher than regular mortgage rates because of the commercial, kind of treated like a commercial loan, but still higher, 8.5, 8.75. And in order to even get the loan, he had to put down over, more than a point. So there was a fee on top of an outrageous rate. And you're right. I think the mortgage companies are like, look, like if we're going to make a loan, we know you're not going to hold it very long. We know this. Everybody knows this. You're going to refinance this. By the way, you're going to pay, points again, but it'll even be worth it to pay. This was a fairly large loan. He's going to pay, five figures to get out of that loan and roll it to a lower rate. So, but they made it expensive to even get into it. So, you're right. I think it's an interesting spot, and this is one. And we've talked about this. This is one of the areas that we do think that Jay Powell is impacted, right? The real estate market, and it's for reasons like this that the money. It just doesn't make sense to put your money. It's hard to make sense to put your money into property when you're paying such a high rate, and even if you don't plan to pay it too long, they're taking their pound of flesh out of the gate. And look, if you want the loan, then that's what you're going to pay today. So, and sometimes people need to do the loan.
It is interesting too when you look at when this really spikes. I mean, the late 70s into 79, 81, inflation times. You look at during market upheaval. I see, 2008, you see a spike up to just below 300 basis point spread. We had it during 2020. We can't say during the sickness. If you say the C word, then we get slapped with something. And then, right now. So I think this tends to cluster the widening of the spread during times of uncertainty, and it may have something to do with not only MBSs but just some of the regional bank balance sheets as well. But yeah, we won't spend too much time on convexity. That's a good way for people to tune out.
To stop listening.
Convexity is like explaining gamma when it comes to option Greeks. I will mention though on the fixed income front, we know that long duration treasuries are really getting hammered. I pulled up a chart the other day, Jay, just the total returns comparing different asset classes within or different types of fixed income. Over the last 3 years, the 20-year plus Treasury ETF is down something like 42% plus. I believe that's total return, including dividends. At the same time, and I mentioned State Street, we use in our ZBIG strategies, so the buffered index growth, where we use very short duration high yield. We take that income to buy long exposure to the market. I mean, over the last 3 years, senior loans are up, close to 11% total return, including dividends. And that's, I think the current yield on that is something like 9.2%. And by the way, I'm not telling you to buy it. We're for the point of discussion. But I mean,
You're saying not all parts of the fixed income world are in a state of disaster. Is that your point?
Well, yeah, and sure. I mean, senior loans and junk bonds as well, or high yield bonds, which are also up. But I think this is one of these, like, if somebody had said, "Hey, I know interest rates are going to go crazy, and I know all this stuff is going to happen." Like, if you were betting against things, you'd probably say, "Oh, there'll be a flight to quality, and people will sell, the high yield stuff." Nope, the inverse. Surprise.
It really is. It is the inverse, and there's been a lot of talk about the big rotation out of high yield debt is coming. All the refinance of high yield debt is coming. It doesn't seem, and we've talked about that in other podcasts, but it doesn't seem to be really impacting performance yet. Not making that recommendation. At some point, we'll have to pay attention to it. It might be a scenario where it'll matter when it matters, but so far, it doesn't look like high yield debt is paying the price like the highest quality debt is paying.
There's another interesting fact that came up on our call with Mark, and I don't remember if I came up with it or he came up with it. It's probably him. It's just an insight, and it doesn't necessarily mean anything. But I jotted it down, and it's, senior loans, the way they work is they are variable rate loans. So as rates have gone up, typically those loans they used to be based on LIBOR, but either 1 or 3 month LIBOR / SOFR, and then there's a margin. So in a weird way, like the companies that have senior loans in the books and as part of their debt structure, like they're almost battle tested. Like they've actually had the impact of higher rates already, where corporate bonds in general, you just mentioned the debt maturity, the walls that are coming up, meaning they're going to have to refinance a lot of this low debt in the next couple of years. I don't know what it means yet, but I just thought it was interesting. And I put in quotes, they've kind of been interest rate tested. Think about that. I don't know what it means yet, but
I don't know. I don't know either. I'm not there. I'm going to digest that one, Derek. We hit a lot about bonds. I'm gonna digest that one and get back to you on that one.
We'll be waiting for that. No, I feel the same way as you. I wrote it down. It's significant enough that I wrote it down as a thought, and I said, And yeah, let's talk about volatility, and then we'll come back to some general market stuff. We're in earnings season right now, Jay, and wow, what a difference! I mean, Tesla had earnings. Disappointed. I don't know. I don't know what Elon said about the Cybertruck. Maybe you do. And then Netflix is the other one that surprised to the upside. Jay, I know you were looking at some data on just, before the earnings announcement for Netflix, the shortest to expiration options were the ones with 2 days left. What were you kind of seeing there right before earnings?
Yeah, I mean, it really is a tale of two stocks, and I don't want to get into the fundamental or the reasons why each stock did what they did, but I think the last 2 days after Tesla's earnings, Tesla's down 15% and Netflix is up like 15, right? So really the opposite direction on the two of those. But interesting when you look at the options market, they were predicting some pretty wide moves, right, in both of them. There's probably a lot of people that thought there would have been exactly the opposite moves that happened, but the size of those moves, the implied move, was interesting. So, for example, Netflix kind of going in right before expiration. When you look at the options market on that, the implied move was an 8% move. And so if you were saying like, oh, that's a pretty wide single day move, yeah, Netflix has done that in the past, and you sold that, you would have found yourself on the wrong side of that trade because it moved 17%, I think 15, 17% the very next day. So this is very normal, right, for you to see a higher premium on options going right into earnings. Now, before there were weeklies, this was a little muted because you might have, 3 weeks before earnings. But we were looking at the earnings we were looking at the options that expired just 2 days after the announcement. And you definitely see a disproportionate amount of volatility and premium. That means how expensive the options are in those options going, right before the earnings announcement. So, by the way, I will say afterwards, the exact opposite happens, right? Once you get the event that has happened, then the option volatility, we like to say the volatility gets sucked out of the chain. A giant vacuum sound takes all of the risk premium right out of right out of them. So let's talk about Netflix for a moment because that's kind of the one that I'm talking about right now. I think going in to Derek, you were nice enough to get this data for me to talk about a little bit. Going into earnings, we saw like 127% implied volatility. That's very high. Typically, Netflix is around, I don't know, 35, 40. So going in, you have this huge premium. And then now that the news is out, I'm talking about Friday afternoon, now it's back down to like that 30 level, right? So if you were a buyer of options, you just had a lot of premium taken out of it. But if you bought the right one, you actually got paid. You should have taken that money off the table fairly quickly. That's kind of the way it goes when you're going to pay up for so much on those kind of options. When you get the move that the market was implying, you definitely want to be able to take some of that off the table. But it's just one of those normal dynamics that we see all the time. It doesn't necessarily predict direction. It just predicts large moves. The same thing with Tesla. We saw implied volatility on the rise weeks going into that earnings announcement. And then, then the move, it just went down instead of up. But the market, the options market, was starting to be willing to pay up. I'm not going to say betting on a big move, but it just means that people buying those options were willing to pay more because they had anticipated a bigger move. That's kind of the general idea of it, of what we saw going in here.
It's interesting because when people start learning about options, maybe the first trade is they sell a covered call, or they go out and they buy a put or a call. And one of the things I remember, and you and I, when we used to be, running the national education, the trading education over at TD, we would always have questions. Hey, everyone knows there's going to be a big move in earnings. Why not buy a put and buy a call simultaneously? Because you know you're going to get a big move. And what you just described is great because the market already knows there's going to be a big move. It was implying 8%. So someone says, oh, I'm going to buy or sell. I used to call this, I think I wrote an article at some point, I don't know where it is, the most dangerous trade. And that trade is somebody says, I'm going to buy a put and buy a call called a straddle or a strangle on, let's say, Netflix right before earnings. And the cost of that was close to $29, or the credit that you would get was close to $29. It's a dangerous trade because you could be right and sell this, and you could be wrong and buy it. And in this case, as you mentioned, if you bought it, you would have made money. You would have had to sell it quick because volatility comes out of it. But I just know, Jay, that, and I know you've seen this as well, it's the whole, oh yeah, things are going to move. Like the options market knows this. The options market is adjusting the premiums in there, and it's already factored in. So Netflix, you're right. It was roughly a 17% move. So, but if you were a seller, not a great day to be a seller. Better day to be a buyer. Next time it might flip, right?
It's right. That's the thing. You're not, there's no guarantee that the options market is right, but you certainly will see a trend on when there's an expectation of a larger move versus a smaller move. That's the interesting thing about options. Derek, I can't tell you how many times we've had people who said, look, I thought it was going to go up and I bought the calls and it went up and I still didn't make money. Yeah, they were expensive. You didn't buy the right calls, which, by the way, it just, means you probably took more speculative risk versus, a hedged approach, all those kinds of things.
Well, imagine you bought, a 5% out of the money call and the move was implying 8%, but it was only a 3% move. And you're down money the next day. Like you got the direction right, but because the move wasn't big enough, or because all the volatility gets sucked out, it just changes.
That's the thing about options. There's three components there. With stocks, is it going to go up or down? With options, right? Do you get the direction, right? The up or down part. Do you get the size of the direction right? And then do you also get the timing of the move right? Right? There are definitely additional complexities when it comes to option positions that are based around a singular event like that.
I'm going to throw something at you we didn't talk about today, but it is around volatility. I didn't throw on our list of topics, but interesting day. VIX was all right. The market was down. What did we close down? It was like, I don't know, 1.4% today. I closed down my trading platform.
Closed at the bottom, right?
So recording this on Friday.
NASDAQ 1.5, yeah.
Yeah. So obviously, Jay, the VIX probably was up, 2, 3, 5, 10% today, right?
I mean, that's normally like a plus on average. That would be like a plus 5 or 6% VIX move, right? There'd be a pop in volatility from that normally. Yeah.
VIX was down 1% today. Huh. That's interesting news. So it's a good lesson, of what VIX is and what VIX isn't. I mean, it's really, Jay, and you can talk to this. I'll let you take this but it's like you could have volatility drop when the market drops, but generally they're inverse.
Yeah, right. And I've done the VIX thing multiple times. I won't do the whole spiel, but right, the VIX represents kind of the people talk about it as the fear index. You and I prefer to call it, the speculative index. So what that means is as usually as the market's dropping, people are either speculating it'll drop more or rebound. So they're willing to pay more for options. That pushes the VIX up, right? Options get more expensive. Well, today, even though the market was dropping, interestingly enough, people were not willing to pay more for options, or there were a lot of people selling options because that would insinuate that they thought the options market was expensive. So look, there's times when this happens. Through actually one point during the day, right? You're right. The VIX was down more than down 2% while the market was down 2%. That's kind of unheard of. So lots of different ways to interpret that, but part of it is where the S&P is moving through the option chain and how that math impacts the VIX, but also how trades were going off. If I had to say something about it, it seems like a little calm before the storm, right? Like a compressing VIX and the with the dropping market. I mean, that could be like a not great sign, Derek, right? Like either that or they're taking their hedges off and they thought that was big enough move and maybe it's over. Maybe the volatility is done and no one's willing to pay for it. They just wanted to take off what if they had made money from the down move that we had over the last 3 or 4 days. This market has definitely had a little lower trend the last 3 days. Three healthy down bars, unhealthy down bars, I'll say. So yeah, Derek, I think it's odd. You usually don't see this 2 days in a row, let alone three. If we see it again on Monday, that might change my mind. That okay, the selling of the options tells us that the directional move is could be coming to an end, which means maybe we're bottoming out. But we'll see. Right, Monday's another day. Monday might be very interesting. Weekends are there's usually a little risk premium in the options going into weekends when there's excessive global turmoil, right, with what's going on in the world. So again, strange not to see that. Just very odd behavior. I guess we'll know what it means next week.
At some point, we'll probably run this ourselves. I did pull up, I found online, somebody did this in 2013, and it was the great days with the greatest SPX decline. So the S&P 500, the SPX is the S&P 500 index, with VIX also down. And you mentioned that 2% level, December 18th of 2008. The S&P change was minus 2.12%. The VIX change was minus 2.5. So VIX back then was 47. All right, so that actually isn't 2%. Here I thought I found a great example. They didn't do this. Is a table. I'm calling this a table crime, Jay. Why don't you just do percent on percent? Like
Here's the thing about your table crime. Like when I look at this table and you look at the VIX positioning, as these down S&P days occur, look at the VIX price, right? How the VIX index level, right? Very, they're all high. They're all high with the exception of this November 1990 that was 20.09, which is more like where we are today. Actually, Derek, that day is almost exact to what we had today, right? Minus 1.25 on the S&P, VIX down slightly, and what happened after that? The next day, the market was kind of flat. Then the VIX caught up. Then the VIX went up the next day. But most of these, Derek, when you look at these, there's an elevated VIX already. There's 47, 42, 35, 44, 31, 38. These are really high levels for the VIX. So I'm not necessarily surprised. So look, maybe this was indicating a top, but when you look at the next day, the results it's really hard to incorporate. Some days are down another 3, some days are up 4, up 2. I think there's a reason you and I have never really dug into this as a real strong indicator is because the data doesn't point to anything that's certain. It's just, but it doesn't happen often, right? The fact that you could call these things out. When does this go back to? 1990, right? So, it's a couple decades. It only happens a handful of times, right? So it is an oddity, but it doesn't necessarily mean anything, I guess, according to this. But I think you and I will probably dig a little deeper. I feel like that's an itch we're going to have.
We got to look at this. I feel like I've seen, maybe it was from the SIBO or somewhere else, that it could be as high as 20% of the time, just on a VIX down, market down, but the VIX could be down like a penny and the market could be down like 3 pennies. So you have to sort of filter it for significant moves. Yeah, more to come on this, because now I'm intrigued. I think you are as well, to see if there's any.
It was just, it just stood out, right? For people that are students on the market, this kind of thing just stood out. Not sure what it means necessarily historically. There's no absolute trend or even too much of a trend, but it's just different behavior.
Sometimes, I mean, I've seen this too, where, as we know, there's the spot VIX, the one everybody sees on CNBC, and then the VIX futures, which have different expirations, different months, weeks, and things like that. And at some point, they sort of converge on the day that the VIX future goes to expiration. The question is, of course, does the VIX future go up, or does the spot come down to sort of meet? That's the question that you can't answer. But sometimes there's things like that. Anyway, we'll do some research on this. Jay, you had also sent me a.
Oh, then I got to throw you one more. I'm going to throw you a curveball.
Oh
no. You and I also watch the VVIX, which is the volatility of the VIX, meaning how expensive are the options on the VIX itself, right? So there's options on the VIX, which is options on the S&P. So there you go, second derivative kind of a scenario. But when you look at that, Derek, it didn't close, but it hit at the highest level, at this 117 level, since the mini banking crisis we had in March, right? So March 20th, it hit that level. Yesterday, it closed at the highest level since then. Today, it exceeded that for a short period of time and then pulled back. So, like the volatility of the options in the VIX is on the rise, right? So that is one of those things typically that's associated with bets that the VIX will spike. There's a lot of call buying in the VIX to push that up, right? Well, that means the market is fearful, or people are speculative on the way down. That usually is a line there. So just thought that was another interesting data point. If there's anything else you'd want to add at it, but I just thought I'd throw that in there. Like the VVIX hit kind of a new high since for the last 6 months, and the last time it got that high was the Silicon Valley Bank and issue.
I think it's smart to bring it up because you mentioned just a few minutes ago the level of the VIX. And when we were comparing some of those days, the highest days, the biggest down days in the S&P with also a down in VIX. But what that is telling me is that the market makers are not letting people in cheap. Hey, VIX is right around 20. You want to buy VIX calls on some sort of a VIX rise or an explosion? You're going to have to pay up for that. And maybe that has to do with how low that VIX level is. That's my initial thought. You threw it at me kind of blindly, but that's where I'm thinking.
I think that was a good answer on the fly.
Yeah.
Good job, Professor.
There you go. All right. Let's move on to something else you sent me. And it has to deal with divergence within the markets. And this was a Wall Street Journal article, not like the old bull market. Jay, all together now, prior to Silicon Valley Bank, things like the NASDAQ 100, the top Russell 50 companies, the S&P equal weight, Russell 2000, Russell Microcap, and the KBW NASDAQ Bank Index, all sort of, they didn't go up the same amounts, but if you drew all these lines on a chart, they're all sort of going in the same direction. Jay, Silicon Valley.
I mean, they're all just overlapping each other almost, perfectly, right? Everything was moving perfectly in sync.
SVB fails, and now it's like the old Sesame Street. Which of these is not like the other, right?
Well, and then they just, boom, they all go in different directions. It's like a scattergun, right? It's just very, very different set of returns after that event. Yeah. I'll talk a little bit about it. NASDAQ 100, the NDX, which includes obviously the Magnificent Seven, which everybody's hot on, up 40% since that time. The S&P itself close to about 20%. The Russell 2000, right? The Russell Index, small cap index, basically flat. I think it's up 5% on this chart. Then you start to look at the micro caps, which are -8. Then, of course, the bank, the KBW Nasdaq Bank Index, down 20 since that event. That one's not so surprising because of the bank risk, but the very different set of returns since that event. Now, as I also read through the article, this is something we always talk about a little bit internally, but it's nice to see somebody put it in print. Usually a bull market needs or is led by the financials and the small caps, right? The Russell and the banks lead out of a bear market and help drive the bull. That did not happen this time around. Actually, the Russell's really knocking on the door of the lows of last year, Derek. I don't know if you've looked at a chart of it lately. The RUT, that's the index that we use for that. I mean, not pretty, right? I'm pulling it up right now as we're talking. When I look at that chart and I go back a year, like it's at the low, it's at a 12-month low. I guess I got to blow this out a little farther when I look at 3 years. It is approaching the lows of September last year, right? So very different story. So if this truly is a beginning of a bull market, this one will not be like others in the past that were led by the Russell or led by the financials.
Don't you think, Jay, that the Russell, a lot of those companies are having the impact of higher rates more? I mean, a lot of those companies have debt, right? I mean, yeah.
And maybe a lot of times the bull starts because the Fed cuts rates, right? And all of a sudden the balance sheet of those small cap stocks looks a lot better, right? They don't have as much payment to service their debt, and that's not going to be the case this time, right? So I think that's obviously a lot of it, Derek. I agree with you, but I'm not sure people realize how much how bad the small caps are doing this year.
Well, you even look at Tobias Carlisle had put a chart out on Twitter, the S&P equal weight index. So that's where every company in there is weighted the same, whether it's Apple, whether it's Yeti coolers or Yeti, who makes the coolers. I guess they make other
I
stuff.
like Yetis. I got a Yeti in my office.
But they're in the S&P 500. Did you know that? I think they are.
Yeah. I don't
Yeah.
have anything interesting in my office Yeti, though. Maybe I should work on that.
All right.
It's
Maybe
just
they should.
water.
Well, we don't take sponsors. So I was going to say maybe they'll sponsor the show.
I would press you to get Yeti to have a sponsorship. I don't know how many Yetis I have. But look, you live in a hot state. You must have Yetis in your house. I
Oh, we
live in
have
a hot
Yetis. Yeah, no, we do. Getting back to the chart at hand, the Tobias Carlisle
This
says.
message brought to you by Yeti coolers. All right, go ahead.
Well, you remember Mike Puck when he had sat in your chair on one of the episodes. We do the recommendations at the end. He recommended like the air conditioning company that put in a new air conditioner. I'm like, really? There's people all over the world. He's given a local pitch to his air conditioning people.
His local service guy. That's awesome.
Yeah, in like Miami, or so. All right, back to the chart.
Right.
So it's down 16% since the start of the drawdown almost 23 months ago, where the S&P is down 11.6. So the point is like the breadth of this market is it's not very strong. And I think your article that you pointed me to, the divergence that we're seeing in some of this stuff, like below the Magnificent Seven, it's been a little rocky. I mean, equal weight is down for the year.
Equal weight is down for the year. So like digest that for everybody, right? Like generally stocks are actually down for the year, right? But look, this is why you buy the index, so you don't have to pick your stocks. We've talked about that a lot of times. But yeah, I mean, it's not rosy. I don't know how many, folks that I speak to. We just had our quarterly reviews, right, Derek? You talked to a lot of your clients. I did too. And there is definitely this quarter felt different than last quarter, right? Meeting in the middle of July versus now meeting in the middle of October. I think it's this, could be, it goes back to the data that we talked about a few podcasts ago, which was, look, going forward, the regularity of 10% S&P years might be over, right? It might be more like 5 for a while, right? Like you just, you don't know, right? But certainly people are feeling a little bit now. I personally was hoping that earnings would pull us out of this, right? Kind of look, August being down, fine. September being down, yeah, almost most years it is. But now that we're, 2/3, 3/4 of the way through October, maybe October is going to be down too, right? So I don't know, Derek. You've brought this up before that just the environment and some of the leading indicators, the long leading indicators, may say that the rah rah years of equities. We might not have one of those for a little while.
But on the flip side, you look at earnings estimates, and I just went back and I said, the forward 12 months are higher now than they've been at any point going back to, I think, the middle or start of 2021. Jay, as of October 19th, the per share estimate is $240. So just to kind of simplify this, a year ago, when we say what's the forward 4-quarter or 12-month estimate, it would have been from October of 22 through October of 23. So now it's October 19th of 23. Over the next 12 months, all the earnings that come out, what's the estimate? It's 240. If I round the S&P down to 4,200, 240 is a 17 and a half forward multiple. It's not crazy. It's not. It's not. So this is like some good news, and margins haven't collapsed completely. They're still holding up. So I always say, and you always say, earnings beyond all else drive things. I remind people that 2022 was a bear market year when earnings went up. They just didn't go up that much. It was a multiple contraction. So what you need to see in this market is earnings to continue, the estimates to continue higher or stay firm. You want to see actual earnings continue to be strong. They've been beating so far. And if Q3 comes in as well as it's expected in Q4, you could have positive earnings again for 2023. But you need people to be willing to pay more for future earnings. Part of that is interest rates. As interest rates go up, the discounted cash flows that come from future earnings aren't worth as much when you discount it back to the present. But above all else, you want earnings. This would be a different conversation if we said, earnings are down 20%. Earnings are going to be down 25%. No. Earnings are not down 25%. They're up year over year.
They're up. Earnings and interest rates, the two things that drive the markets, right? And this is a biggie. This absolutely matters. How much companies make drives stock market moves. No doubt about it. It's nice to see that it's up. I'm going to throw this in there. So why am I'm the downer today, Derek?
Don't be the downer. Things are good. Net worth. The Fed just released their median net worths through the survey in 2022. Everyone has more net worth. I'll get to that later in another episode. But things are good. Things are good. Things are dangerous sometimes around the world, but
let's leave it. Things are good. I'll leave it that way. That's totally fine.
All right. By the way, what happened with the Cybertruck? Did Elon say they're not going to make it, or I don't know. I missed that.
I think he said it's going to come out in November.
Oh, is it? Okay.
Yeah, all it's coming out in November. Look, the big drawdown on Tesla was, expected 17% margin, and they came out with a 7% margin. It was just, it really was not great. Hey, earnings. Does it relate to earnings? Yeah. Stock went down? Yeah. There you go.
I almost think he's either playing the long game, or he's like, you know what, we're going to reduce all our cost, and we're just going to continue to own the space, and we don't care if we don't maximize margins. And the Fords, the GMs, Tesla on the EV side still has they're the biggest player. They're the most important player. I don't know what, that's what people want. So it's kind of one of those things, they have the margins to cut. So
yeah, look, we have a client who put a Tesla roof on his new house. He loves it. He's got the Tesla walls, the batteries in the walls, right? And he stores up energy during the day, uses it at night. Said there's a cool little dashboard that he gets to watch how much energy he's building up. It's he's very happy with his Tesla roof and Tesla walls. So maybe it's more than the car story.
I don't know what that who knows what's going to happen with the stock, but it's just yeah. Cybertruck looks pretty cool.
Feels like that's a good thing in general, right?
Yeah.
I think we all hope that works. I guess unless you're Exxon. Well, maybe they even hope. Who knows?
Well,
sorry if you hold Exxon.
See, that's a whole other discussion.
All right.
Supply. You want me to get it? I'll pull my supply and demand.
No. But by the way, that was in the news the last couple of days, right? Like, the U.S. has drawn down their supply, and I just said you have been listening to Derek, who's been talking about it for weeks and months.
I do talk about it for weeks and months. All right, Jay. Last week you missed a really good recommendation, so I'll give it to you live again. It's Reptile on Netflix. So the audience last week got that. I enjoyed that. That it's a movie, so it's not a show, not a big commitment. Justin Timberlake, Benicio del Toro, Alicia Silverstone is in it. Haven't seen her in anything in a while, but I'm giving it a strong buy recommendation. So
Reptile. Okay.
Reptile. Yep. I have another one, but what do you got this week? You're probably watching stuff on the plane.
No. They were early flights, so I slept on planes. It's a little bit of one that I watched once, and I think I ended up really liking it enough that I'm going to have my wife watch it with me. I'm willing to watch it again. It's Severance from Apple. So it's old, and I think the second season is coming out, so it's good to kind of catch up on it. Very, I don't know if you watched it. You're an Apple guy, Apple TV guy.
I haven't. I know what it is. I haven't seen it. Yeah, it's good.
I'd say watch it. Say why. I'm going to definitely watch when the second season comes out, which I think is coming shortly. So catch up on it.
Sticking with Apple TV, I started to watch the morning show. I'm unsure of it yet. I'm giving it a hold recommendation right now, but more to come on that.
I give it a buy. You should watch it.
Oh, you give it a buy? Okay.
Yeah,
I'm only through
in the middle of season 3 right now. Yeah.
Okay. Yeah. All right.
Yeah. I mean, watch it with your wife.
She's already watched it. She already watched it.
She just wants you to get caught up. See, I knew she would like it.
I was like, "Is it any good?" She's like, "Yeah, you should watch it." And so we'll see. I'm early into it. More to come there. It's a hold recommendation for me right now.
I think it was a little more powerful. The parallels were more powerful a few years ago, but they do a good job of aligning with current events on a lot of their topics. Not exactly, but sounds like it, smells like it, right? So, yes, you should watch it. John Hamm is in this season, and I like John Hamm.
See, you ruined it for me, Jay. I didn't know he was coming. I would have known.
Season 3. You got a ways to go, buddy.
Well, I don't know what he's all about. I got to figure this out. You know what it reminds me a little bit is, one of your recommendations was The Newsroom with Jeff. What is his name? He was in Dumb and Dumber. Jeff Daniels, yeah. Which I watched when it was out a couple of years ago. It reminds me because remember they would trail things. They would do things that were a couple of years ago, but they would do them as sort of current events. So, yeah.
Correct.
It was good.
They're good.
All right. So there you have it. All right. We did it, Jay. We got a lot of material there. Lots going on in the market. We definitely will have to look at this VIX going down, S&P going down, or maybe the inverse. We'll come up with something on there. Take a look at the
we're gonna throw it into our little VIX trigger machine and see what pops out.
Yep, and Netflix, Meta is coming up, the big one next week, right?
Lots of earnings next week, right? I think Microsoft, Meta, Google might be in there. Alphabet, for those of you that like to call it that. Yeah, big tech earnings. Week of the 23rd. So we'll see. We'll see if it can turn the market like it has turned many other times.
Very good. All right, everyone. We'll be back next week with more hilarity and insights into markets and the economy. How's that for a close, Jay? I don't know why I wanted that. Let's just close. See you, everyone.
Hilarity? Bye.
Bye.